Thanks, Lauren. Hi, everyone. My name is Hudson Bova, and I'm a principal on our CFO services team at Pilot. I spent the majority of my career working in traditional finance fields, including investment banking, M&A, and private equity investing. I joined Pilot a little over a year ago with the goal of helping founders of fast-growing startups optimize their businesses through the lens of strategic finance. Many of the strategies and tools we'll be discussing today have been implemented across our customer base with the intention of helping founders navigate this especially tricky macroeconomic environment.
Hi, everyone. Hi, everyone. My name is Shannon. I'm a part of the strategic finance and business operations team here at Pilot. Similar to what Hudson does for his founders, I do for Pilot. Since the markets have turned, what that means is we've taken a deeper look at the impact of our hiring plans, marketing plans, and reviewed our own cash position and revenue performance. Today, we'll cover some general best practices and actions you should take as soon as possible, both with and without a finance team. And then afterwards, Hudson will deep dive into more tactical cash management tools and tactics that can help you plan and adjust for the future. Please note we have a Q&A tool that you can use throughout the session, but more likely than not, we will take questions at the end during a live Q&A portion. So let's get started. One of the most helpful things you can do in a time like this is to do some scenario planning, which is making assumptions on what the future is going to be and how your business environment will likely change over time given that future. As part of that exercise, you're going to want to monitor key metrics that will guide your decision making, like burn rate and runway. Burn rate being the rate at which you spend your money, and runway being the amount of time you can continue to operate until you run out of cash. Depending on where your runway comes out to be, below is some guidance to consider in regards to fundraising, growth plans, and headcount readjustments. Note that every company's situation is different, and these are just some general considerations if you're in one of these situations. If you have less than 1 year runway available, this is a bit more of a crisis mode where it would be helpful to look introspectively at your company and see where there are areas of fat you can trim, or what people or products are the key drivers for your business. With so little runway left, you should probably consider seeking fundraising or seeking alternative forms of capital. Many founders jump straight into seeking fundraising, but sometimes alternative forms of capital like loans and revolving lines of credit could be a better fit for your needs. Obviously, reducing headcount is always the last thing you should want to do, but if needed, make sure you are keeping the key impactful individuals. Some management teams have been more liberal with reducing headcount in times like these, so that they will not need another round of reductions and they can minimize the cultural and morale impact of multiple rounds. At 1 to 2 years runway left, this is a less critical mode, but you are still looking to extend your runway as much as possible. Fundraising may be needed at this time, but this is ultimately a time to cut down on excess and unnecessary spend. This may be in the form of delaying non-essential hiring or tabling some of your aspirational growth plans. If you have 2+ years runway, this is great news, and you should be proud that your company is in a great place. However, with an oncoming recession, we never know how long it will last, so it's best to not squander away your cash. This is a good time to carry on your operations and see this as a potential opportunity to grab market share from competitors who might be struggling. It's also a good time to pick up any capable candidates that are leaving their own companies. We understand that some of what Hudson shares later on might be overly complex or a time suck for a founder looking to solve some of these issues and manage their cash. But there are some things you can do if you don't have a finance team. First, you can look at what you should cut and what you should keep. In terms of what you should cut, you can look at recurring expenses and trim where you can. Pilot and other providers like some credit cards can help you here by flagging your recurring expenses and how they're trending. This can be super helpful when you're looking at subscriptions and other contracts to negotiate. If you don't have a tool that helps you here, you can still do this on your own by looking through your bank statements month over month and evaluating where your spending has increased. Once you've looked at your expenses, you can cancel or renegotiate your vendor contracts. A note here, software contracts are typically negotiable due to their higher margins, while service agencies like marketing agencies or even Pilot are not. It ultimately will not be a good use of your time because many of these businesses are already operating at the lowest margins possible. You should also think about what you should keep. Key resources required for you to hit your next milestone are definitely ones to keep. These can be in the form of key engineering and product teams that are critical to the operations of your business. Ultimately, you don't want to make cuts on programs or projects that are the bread and butter of your business. Secondly, teams like your compliance, accounting, tax, and legal teams are the last teams you would ever want to cut. These are the teams that are most needed in these times because they are needed to prepare you for your next raise and to keep you out of hot water with regulators. Now I'll pass it over to Hudson to deep dive into the more tactical side of things.
Thanks, Shannon. Before we dive into specific strategies and tools CFO Services utilizes to help with the business's cash flow needs, we first need to discuss a fundamental shift in focus with the founder. The founder should adopt, if cash flow and cash are immediate concerns of the businesses, a founder should adopt a short-term focus versus a long-term focus. When we talk about financial forecasting with founders, many have a long-term view of the business, incorporating growth plans into an ambitious multi-year forecasting tool. While this type of operating model is useful in certain circumstances, when cash and the immediate operations of the business are a concern, founders should immediately shift focus from long-term forecasting mindset to a short-term. So what does that mean? Whereas a long-term forecasting focus is achieved through an operating model, which includes ambitious growth plans like hiring and sales and marketing investments, a short-term forecasting focus relies on a weekly cash flow model where conservatism is key. Conservatism means that we want to beat the forecast on the upside, not the downside. We want to build a downside scenario where revenue is diminished while the business's cost structure remains the same. In other words, we're modeling a seriously impaired business environment that the team is operating under. The goal of a 13-week cash flow model is exactly this. It is to analyze the weekly inflows of cash that are generated through customers and the outflows of cash required by vendors. We'll see an example of a 13-week cash flow in a minute, but what you'll see is cash inflows like bookings and cash outflows are expenses categorized by weekly period and by each vendor to precisely understand where cash inflows and outflows are coming and going and by how much. This tool allows founders to understand where there might be bloat in OpEx, while also providing a precise cash zero date with meaningful granularity. As you can see here in this 13-week cash flow model example, we have weeks across the top, not months, which is why it's called a 13-week cash flow. 13 weeks is a fiscal quarter. Working down the side of the model, we have bookings for this SaaS company, representing cash receipts, and cash disbursements broken out by vendor. This model utilizes the cash method of accounting, so cash inflows and outflows are being tracked in the period that they're recognized. That is, we're not accruing or amortizing any accounts. This model uses bank statements as a source of truth for cash inflows and outflows, and some ifs to categorize transaction inflows and outflows and by vendor. As you can see, this type of modeling tool provides additional visibility as to where cash is coming from and going. We can also do a few different things with this output. For example, we can see which expenses are reoccurring on a quarterly basis. Google Ads is a great example, where we can expect to spend $500 per quarter for the service. When we begin to see these patterns, we can extract forward these future cash outflows, creating a detailed forecasting mechanism. Even more powerful, we can also see expenses that are 1 or 2 standard deviations from the mean. This allows us to identify and independently verify certain expenses that seem unusual. In this particular example, I've highlighted in red some major expenses that we pulled purchase orders for. What we found was that this particular customer was not taking advantage of 90-day payment terms, but rather paying their AP in the period it was incurred. These payment terms are a form of financing that businesses should take advantage of if they have access to it. This is just one example of building a forecasting model with this level of granularity. First, you need to identify where there is bloat or favorable terms, and then appropriately manage around these items. Ultimately, the 13-week cash flow model is more useful in determining short to intermediate term cash balances for a few reasons. First, if you think about an operating model, balance sheet items are projected at a very high level through ratios, like AR and AP days. In the 13-week cash flow model, we're projecting specific cash expenses based on patterns and expectations for the future, which are generally more directionally accurate than using computed ratios. The second reason we can't deeply rely on the cash flow projection of an operating model is because it's generally expressed on a monthly basis, which does not give us the beneficial visibility into the precise zero cash date. Together, these two aspects of the 13-week cash flow model make it a valuable tool in the founder's toolkit to understand the precise short to intermediate term needs of the business. Cash management is top of mind to founders everywhere right now. Capital efficiency and managing cash runway is critical at the moment, as the conversation with investors are becoming longer and are more focused on profitability and efficiency. Growth at any cost has fallen out of favor in this weaker operating environment. Before I get into the founder tactics, a quick PSA. We'll be graphing each strategy on an XY plot along the side of the slide. What we're trying to convey or illustrate is the speed at which a particular strategy can be implemented and whether a particular strategy will have a positive or negative impact on the business. Broadly speaking, we have three major levers we can pull to impact the cash runway of a business. The first is optimizing the pricing and AR structure of a business through RevOps. The second is identifying operating expenses that are bloated, non-critical, or have the embedded payment terms I touched on earlier. And finally, tapping into traditional or alternative financing options for the business to raise incremental capital is another way to bridge cash management issues. As we can see from the graphic on the right, the highest potential for negative impact to the business is by drastically cutting expenses. Typically, these outlays of cash support business growth, like a hiring plan or sales and marketing investment. The critical component here is being judicious in which expenses to cut so that growth is not severely hampered. And most founders will have an idea or gut feeling as to which areas to cut. Revenue optimization is typically net neutral or slightly positive if done correctly. This means if price points or payment terms are adjusted, the rollout has hopefully been tested on new customers and validated by market forces. By A/B testing new price points or payment terms, founders can typically measure the net long-term effect on the business. And then finally, we have financing and raising additional capital, which is usually positive for the business, providing critical incremental capital to fund growth. Some combination of all three of these strategies should be considered for every business, and no two businesses will have the same combination. Each of these strategies should be carefully planned to maximize cash runway and growth strategies. And now let's dig into the specific strategies. We'll start with revenue. From a revenue perspective, there are three major things we can do to optimize the pricing structure of a company. Well, it's not as simple as raising prices for all of your customers because that could adversely affect volumes. We do suggest performing a market analysis of your 3 to 5 nearest competitors to determine where they're pricing their product in the marketplace. Inflation is rampant in all areas of business at the moment, so benchmarking your product's pricing to market dynamics is something we're suggesting to all of our customers. We want to maximize gross merchandise volume your business is producing, meaning that price times quantity, which is a fundamental equation for sales, is maximized. Some businesses have a high price and low volume, while others have a low price and high volume. Regardless of your fundamental approach to the go-to-market, these two variables should be optimized to produce the greatest sustainable inflow of cash. The second thing we can do is structure our pricing such that we're collecting as much cash upfront from the customer as possible. We want to have unearned revenue, which is another form of implicit financing for our business, rather than accounts receivable. The difference is that bookings and unearned revenue, with bookings and unearned revenue, we're collecting cash up front, whereas AR provides payment terms to our customers. We want to shorten our payment terms to customers while closely monitoring AR if you have it, so that collections are being made in a timely fashion and nothing is going stale. Businesses and customers are struggling across the board, so closely monitoring collections is critical right now. And then finally, there are alternative forms of financing for AR and ARR that provides one-time cash inflows today for future revenue. These alternative forms of financing can be expensive, but if cash today is an issue in the short term, these are very real and meaningful options for businesses across the chasm. Essentially, you're selling AR or future ARR at a discount to providers who will monetize it today. The second major lever that founders can pull to managing cash runway is, not surprisingly, expense management. A common initial reaction by founders is to cut everything that seems unnecessary, but I would caution that cutting things like sales and marketing spend could have negative ramifications on the overall business. So again, taking a judicious approach to cutting expenses by analyzing weekly spend is critical with this particular strategy. And a 13-week cash flow model can really help to determine where there's overall bloat in the company's cost structure. Here are some examples of non-essential spend that should be considered for cutting. Long payback customer acquisition costs, so customers that have a CAC payback of greater than 12 months. Unused subscriptions, optional travel, office improvements, and CapEx. Some examples of essential spend are customers with short payback CAC, less than 12 months typically, COGS, key employees in technology, taxes, and legal, accounting, and compliance. The second strategy within this major bucket relates to extending outstanding accounts payable. In other words, stretching your payment to vendors to take advantage of customer-centric payment terms. This does not mean do not pay your vendors, but rather dig into each of your vendor payment terms and really stretch the need for a cash outflow. Additionally, leveraging revolving credit lines like credit cards is another way to lengthen and protract these payment terms with vendors. And then finally, managing headcount is another cash flow strategy, but has the largest potential negative impact to the business. Downsizing is absolutely an escalation path for businesses with no additional paths to take. We recommend cutting deeper on the first pass rather than having multiple downsizing rounds. Psychologically, multiple headcount reductions have proven to impact employee morale and their efficiency, which could start a self-fulfilling internal flywheel that could hurt profitability long-term. Consequently, we recommend starting with cutting unnecessary perks and non-essential contractor engagements. Additionally, pausing founder salaries and even salary reductions for certain key individuals are also viable strategies that would act as stopgaps. There are also optics at play here, where senior stakeholders take voluntary pay reductions for the sake of the business. Optically, the messaging is, we believe in the long-term vision of the business, but we need to get over the hump today to achieve this vision. And we're willing to forego our normal salaries to get over that hump. That's motivating from an employee perspective. I'll touch on fundraising briefly, but financing has the longest implementation time and potentially the greatest positive effect on the business that requires funding. Prior to this year, the rule of thumb for fundraising was to begin the process with 6 months of runway. That's now extended to approximately 12 months. We're seeing processes take longer with much deeper diligence periods. There are now more than ever multiple forms of fundraising, starting with their typical equity infusion. We're also seeing an uptick in venture debt across our customer base. Venture debt does not have the same expected dilution that an equity raise has, especially at depressed valuations, but venture debt comes at the cost of free cash flow. In other words, VC debt typically has an interest rate and must be repaid at the end of the term. Nevertheless, we're seeing many founders solicit their existing investor base and asking for venture debt to bridge to a certain milestone or goal. We found that a clear path to profitability or a product feature release is the type of story that resonates with investors, which improves the potential to successfully take down this type of financing. Typically, businesses that have strong margins and free cash flow are most likely to be successful with raising venture debt. Finally, the outright sale of the business or part of the IP is also a viable option for companies that require immediate help with cash flow and do not see a viable path forward with any of these other strategies. None of the strategies we have discussed are mutually exclusive, and implementing a combination of these tactics sooner rather than later is best practice. As we have identified, certain tactics take longer to implement than others. So if you see the potential for having to implement certain long-term tactics, start thinking about them tactically and quantify their impact so you're ready to adopt these strategies when they're needed. In this vein, the time is now to begin resetting goals in this macroeconomic environment. We just exited a period of easy money and a growth at all cost mindset. While I can't say if or when we'll return to that environment, what I will say is that founder expectations should change now with this current economic background. From a modeling perspective, build that downside and zero revenue case. Plan for a difficult operating environment for at least 12 to 24 months. Expect lower customer retention and smaller round sizes at lower valuations. We suggest adopting that wartime mentality, scrutinizing every expense and growth plan right now. How you perform through this volatile period will be a testament to investors further down the road as to how the company will perform in other difficult environments. And lastly, when you do go out and fundraise, investors are now more focused than ever on capital efficiency and profitability metrics. Things like burn multiples, a fulsome understanding of CAC and CAC payback, margin metrics like the Rule of 40 are now central to every conversation with investors. Equity stories and KPI tracking should absolutely have these elements in them to not only show investors that you have a grasp for the current operating environment, but also to show that you care about these metrics as a principal stakeholder. Now, Shannon will present another form of cash management through the R&D tax credit.
Thanks, Hudson. There are a few other tactics that founders can use that can really help you save money instead of just managing your cash. A lot of these involve government assistance subsidies and credits, specifically R&D tax credits, employee retention credits, loans, and grants. We'll dive more into R&D tax credits given its complexity. The US federal government and various state governments offer a business tax credit for companies that incur research and development or R&D costs in the United States. When I speak about R&D costs, I mean any payroll expenses for employees or contractors based in the US or machinery used to create prototypes. These credits can be used to offset future payroll tax liabilities and or income tax liabilities. You can earn up to $250,000 in credits per year, and if you don't use up all your credits in 1 year, you can use the excess for 20 years forward. In general, startups that are 5 years or younger, meaning your sales started less than 5 years ago, and with $5 million in annual revenue or less, may qualify for these credits to offset payroll tax liabilities. For companies that are older than 5 years, you can still claim credits, but they can be used to offset income tax liabilities. Companies can also claim this credit retroactively by filing amended returns for the past 3 tax years or more, if your company has endured losses during that time. Some topics you may be asked about in qualification include date of incorporation, year of first gross receipts or revenues, total revenue in the last fiscal year, whether you're a tax-exempt organization, whether your company makes proprietary technology, whether you have patents or are planning on applying for patents, if your company has any projects where your team has faced technical risks or challenges, and if you use experimentation or iteration in your tech development cycle. In terms of how to actually claim the R&D tax credit, here you can see the actual forms you need to fill out. It looks pretty straightforward, but oftentimes it's a very time-consuming process where if done inaccurately, it can be a low ROI on your time. In this process, one of the most critical steps is the tax credit study process, which is the process to determine if you qualify for the credit and which expenses would qualify. Because this part of the process is essentially proving to the government that you and your expenses fit into their predefined framework, this is oftentimes a subjective process around how well you can make your claim. Some applicants will do this themselves, and others will seek service providers like Pilot, who will conduct the study and file the tax credit form for them. There are different fee structures out there depending on the provider, but for us in particular, we charge based on the final submitted number to the IRS, and from our team's technical expertise, 100% of our tax credit applications have received money they filed for since the service was introduced in 2016. And that wraps up our presentation for today, but we love to open up the floor for a live Q&A.